We now shift focus to the insurance sector, and we have GIC Re, which is in focus, that is General Insurance Corporation of India. Now, the company reported its March quarter numbers where its profits rose 3%. And we caught up with the management on the quarter gone by. Do listen in.
In Q4, we have performed well. While the growth has not been there, and this is something that we have been saying the entire year last year, that we are not planning to grow in the last year. All the growth would happen this year. So last year, in spite of that, we had a growth of 2% for the entire year. And our net profit also grew by 3% to 6,500 crores. This is a record profit for GIC that we have not had this kind of profits in our entire history. So this augurs well for the future. This is in spite of having about 9 catastrophic events in India last year. In spite of that, which typically took out about 3,500 crores of losses from our book. Now, when you look at that and you see how we have performed over the year, Q3 2023, we had actually had a combined of 118. And we had at that time given a guidance that we would improve our combined ratio by about 4%, because normally the Q4, the quarter 4, which is the Jan, Feb, March quarter, is normally a benign one where we don't expect any catastrophic events either in India or abroad. So with that in mind, we have actually done better. We expected that our combined ratio would go down by 4%. It's actually gone down by 6%, and we are now close to 111.8, which when you compare with the previous year, we are about 2.5% higher. But like I said, there were 9 catastrophic events that hit India. And if you add the losses that came up in those events, that adds up to almost 3,500 crores. That is under 10 percentage points in terms of combined ratio. So in that respect, we are very satisfied with our results, with the way our book is performed. And that gives us a lot of confidence going forward. For the current year, we expect a good growth. We expect growth to be about 15 to 16% at this stage. And depending on how things change in the future, we could grow our book much further. But at this point, we would say that for the year 24-25, we would grow by about 15 to 16%.
Okay, so growth to make a comeback. And before I come on to the growth piece of things, sir, talk to us about sustainability of the combined. I understand it depends on various factors and one-off events, contingencies and the like. But talk to us about just where you see the combined at a reasonable probability level. Can it sustain below the 100% mark now? Is that something one can reasonably expect?
The 100% mark is something that would take a bit of time. It is a journey that we have already embarked on. Like I said, over a period of time, we would bring down our combined to below 100. It would depend on a multiple of factors. It would depend on how the catastrophic losses, how the climate change impacts our book. How do we manage to, bring a semblance of order in the way we manage to bring different kinds of businesses into our book to enable that the catastrophic events don't play a big part. And that's what we are doing now. If you see, a major part of our book today is health, is motor, to a bit of an extent, agriculture also. So these are, one way of ensuring that catastrophic events don't play a big part in your overall book. So that is something that we have done. Secondly, you also need to ensure that there is a good diversity and spread in your book in terms of the different markets that you write. And that is something that we will do going forward. For that, to build our international book, we will need to ensure that our international credit rating comes back to at least A-. So that is something that we are working hard towards. We already have a meeting with the AM Best guys who will be doing the rating for us. That is slated in July, where we will be putting forward all the good points that we have done over the past few years to ensure that our book is very strong, the portfolio is good. And like I said, last year, if you see, catastrophic events were 9 in number in India alone. And in spite of that, we've managed to post good profits and managed to ensure that our combined ratio has not gone way beyond the normal range. So that gives us a lot of confidence that the way we have put together our portfolio, it's going to work for us. The point that you raised, whether we will reach 100, yes, we will, but it will be a matter of time. I think initially we will be more comfortable reaching a stage where it is close to 104 to 106 range.
Understood. So would that be next year, 104 to 106?
That will take about 2 to 3 years.
2 to 3 years to get to 104, 106. Okay, and
Yes.
I want to touch upon international, because that's been one of the key drags on your combined. It was 135% plus last year. You brought it down to a more controlled 125% plus. You see this kind of trajectory reduction sustainable into FY25 as well? You continue to bring down the size of the book of the underwriting as well. So just want to try and close those loops.
So the international book has more or less remained where it was. I mean, we have not grown the book much. Like I said, we need to get our international rating in place to ensure that we are able to access good quality business. Now, like you said, the combined has been a problem in the international book, basically because of the catastrophes. But now we are in a position where we are able to manage that. And like you said, compared to last year, the combined for the international piece has come down from around 138 to 125. Honestly, it would have come down further. The only problem was there was one contract that we had written sometime between 2017 and 2020, which is now become a bit of a problem this year. But again, we have ensured that the provisions have been adequately made so that going forward, that business will not hurt us. This was a business that we wrote in the US, where the premium has come in the years 2017 to 20. But then we came out of that contract because we realized that it is really not working for us. But now the claims have come, and honestly, we've paid about almost $260 million of losses this year. As you can see, if that business had not been there, my combined would have come down by 20%. It would have been close to 105%, which is a very comfortable place to be. Because domestic is currently at 105, and touch wood, if we had not had these losses in the international book, our overall combined would have been in the 105 range. Like I said, that is an area where we are very comfortable, where we believe our book works at the best possible levels. But we already provided at the best levels for the contract that I'm talking about. And next year, we don't expect that problem to happen. So next year, the combined for international book would be much, much better.
Okay, is this in the cargo vertical by any chance?
Yes, it was cargo. It is a contract which had cargo and motor as its business. And as you would know, these are businesses which are pretty long term in the way it functions. So while the premium came upfront, the losses are coming now.
Got it.
Okay. It had been a good contract. The premium we had continued with the program. The premium would have continued, then it wouldn't have shown that kind of a stress. But unfortunately, it didn't really work for us. Currently, the combined is at around 109. With provisions, it is at 137. Honestly, it's not a business we want to be in.
Understood. Sir, just on growth, I want to try and get perspective. So the 15% kind of growth that you're targeting in premiums next year, how much of it from domestic, how much of it from international, and what's the mix going to be like? What's the expected mix going to be like?
I think the entire growth is going to come from domestic. Reinsurance is a business which grows in chunks. So you have one major chunk for us happening in 1st of April, which is our domestic renewals. Then you have one major chunk happening on 1st of Jan, which is our international renewals. And there are some businesses which happen through the year. So that one major chunk in April, we have grown substantially. And that is where, based on that, we believe that our growth will be about 15 to 16% going forward. And that entire growth will come from the domestic market. So our mix, which was around 70% domestic, 30% foreign, will improve more to the domestic side. So domestic would be more around 75, 76%, and international will be 24%. But this is in the short term. As we get our credit rating and as we start looking at international business, that business will start growing.